Over the course of the last month, a record 22 million people have filed for unemployment, and that number is only expected to grow. Unsurprisingly, headlines of an impending recession have become a regular thing. Many economists even think we may be in one now. But how will the 2020 recession look like? And how will it differ from recessions of the past? While we can't know exactly how the future will go, we can make an educated guess. Around the world, entire economies are being put on ice, with non-essential businesses closing down and people being ordered to stay at home. Many countries have closed their borders, and worldwide tourism has nosedived in the span of just a few weeks. To date, the United States has imposed travel restrictions on people coming from China and Western Europe, declared a national emergency, and passed 3 different emergency spending packages, with a possible 4th on the way. This time though, there's a catch. Unlike previous economic downturns, the federal government can't just make decisions solely aimed at keeping the economy afloat. It now has to try and balance its public safety responses with its economic ones. Compared to the Great Recession of 2008 that was fueled by a housing bubble and subprime mortgage crisis, this recession is largely being caused by something more abstract that we can't directly see or feel. All throughout March, governors from coast to coast have issued stay-at-home orders and closed a majority of businesses that were deemed non-essential. Movie theaters have emptied out, restaurants are only doing takeout and delivery, and retail stores have closed for an indefinite period of time. Once bustling cities now seem like ghost towns, and countless small businesses have been thrown into financial duress, leaving millions of able-bodied workers jobless. It's a situation unlike any other. Going into 2020, unemployment rates were at record lows, but that's already begun to change. Some estimates expect over 40 million Americans will be unemployed, numbers that are unheard of since the Great Depression. The ripple effect of so many people becoming unemployed in such a short time has had an instantly noticeable effect. Following the Great Recession in 2008, the United States went through a record 11-year-long economic expansion, with over 21 million new jobs being created in the process. But now, with 22 million unemployment insurance claims being filed, it's unclear how many of these jobs will have managed to survive the shutdown. In response to the turmoil, the Federal Reserve has cut interest rates from 1.5% to nearly 0%, and has begun purchasing treasury and mortgage-backed securities to inject more cash into financial institutions. This is what's known as quantitative easing, where the Fed increases the total amount of money in circulation to encourage lending and investing. In addition to moves taken by the Federal Reserve, the federal government has responded to the economic shutdown with a total of 3 stimulus packages. The first provided $8.3 billion in funds for health agencies and small business loan subsidies. The second came in with a price tag of $100 billion and provided tax credits for employers providing paid sick leave. It also provided extra food assistance and a temporary increase of an additional $600 a week in unemployment benefits. The most recent stimulus passed at the end of March and came with a massive $2.2 trillion price tag. It provided direct cash payments of $1,200 to many Americans and $500 billion in bailouts for large corporations in industries like aviation, tourism, and hospitality. But despite the stimulus being the largest ever passed, Washington is signaling there might soon be a need for another, and they might not be wrong. Because despite the $1,200 cash payments, it was recently reported that approximately 1/3 of Americans missed their rent payments in April. While a fallout like this might sound surprising to some, to others it might be seen as something that was a long time coming. Back in 2018, before all the lockdown madness started, it was estimated by the Federal Reserve that 40% of Americans would struggle to come up with $400 to deal with an unexpected emergency. Now that an emergency is rising, it seems that the estimate was true. Some early ideas for what a 4th stimulus package could look like currently include further direct payments to individuals and enormous infrastructure spending to jumpstart the economy on a national level. Of course, there will be a great deal of wrangling over the fine print between a very divided Congress. But a 4th stimulus, especially one targeting America's old roads, bridges, and highways, seems more likely than not. The Bureau of Labor Statistics estimates that just under 1/3 of the American workforce is able to telecommute. These jobs are found to be highly concentrated in industries like tech, finance, and media. Uncoincidentally, those most affected by the shutdown are workers in the service sector, which makes up roughly 67% of the economy. The outlook on Wall Street hasn't been much brighter either, with the Dow Jones posting 2 of its worst single-day losses in March and experiencing increased volatility since. As it stands, there doesn't seem to be a solid plan for how and when states will truly be able to justify ending lockdowns and reopening for business as usual. It's likely we won't know the full scope of our economic losses for some time, nor how long a full-fledged recovery could take. There's 3 ways economists like to describe recessions: neither a V-shape, U-shape, or an L-shape. The best case scenario would be a V-shaped recession, where economic losses are sharp but make a quick recovery. By comparison, a U-shaped recession would last longer and have a slower return to upward growth. The worst case scenario would be the economy entering into an L shape, where losses are steep and growth rates remain flat for many years. The most famous example of an L-shaped recession was the Great Depression of the 1930s, or, more recently, the still ongoing Greek debt crisis. In the short term, financial institutions are predicting a second quarter decline in GDP of anywhere from 24 to 40% before things start to slowly rebound in the second half of the year. But even after the initial shock of the decline is done, it's not expected to be smooth sailing the whole way out. While many will eventually be able to go back to their old jobs, depending on how long the shutdown lasts, many may find that their old jobs no longer exist. The housing market may also be on slightly less stable footing for some time to come. While we don't know how bad things will be in comparison to the rate of foreclosures during the 2008 housing crisis, we do know that in March, requests for mortgage forbearances were up roughly 3,000%, with more than 2.9 million homeowners taking part in the new government forbearance program that was rolled out with the last stimulus package. The thing with mortgage forbearances, though, is that even though it defers or lowers payments for a period of time, the interest owed on the mortgage still keeps accruing, and all the money that would have normally been paid in monthly installments is still due at the end of the forbearance. It's very possible that when this grace period is up, that many people will still have trouble making their monthly payments. This, compounded with debts accrued during the lockdown, may be enough to cause an increase in the amount of foreclosures experienced, even after the economy starts growing again towards the end of 2020 and early 2021. According to a study by Fannie Mae, the Federal National Mortgage Association, home sales are expected to drop by 15% by the end of the year. With many people unemployed and unable to afford first-time homes, and a decrease in sellers due to lockdowns, it almost certainly won't be until 2021 that the housing market begins to properly rebound. The seemingly new reality is that even if the recession is sharp but short, things will take a long time to return to normal. Unemployment numbers were at record lows before the shutdown and are unlikely to be that low again for a long time. And while we may see an initial strong rebound with economic growth, it's going to take time for people to get firmly reemployed and for consumer spending to resume its reliable position as a driver of economic growth. It also stands to reason that people won't feel confident traveling, commuting, and socializing in a way that meaningfully stimulates the economy all at once. While federal stimulus packages may keep things afloat for the time being, that by itself poses another threat in the form of mounting debt that currently clocks in at over 100% of national GDP. In our increasingly globalized world, it's going to take a collective rebound by all developed nations to rebuild supply lines, restart factories, resume international trade and travel, and restore stability in financial markets. The effects of this recession are already being felt around the world, as Italy and Spain, 2 of the largest economies in Europe, are expected to post an overall decline in growth by the end of 2020, with many expecting that the continent as a whole may be posting negative figures as well. Even China, after having 28 years of consistent economic growth, has reported a 6.8% decline in the first quarter of the year. Oil prices have also reached new lows, as demand has plummeted in recent weeks due to the worldwide shutdowns in manufacturing and transportation. As more time passes, we'll gradually be able to form a more clear picture of what the future holds. Governments the world over are likely to continue with economic stimulus policies for as long as lock-in measures remain in place. Even when social distancing measures begin to relax, it most likely won't be a snapback to life as we once knew it. Society will need to slowly ease back into a somewhat normal state of being, as businesses selectively reopen and people re-emerge from their homes. While the current situation is new and uncomfortable, it's more a question of if rather than when things will get back to normal. Despite the way it might feel, the streets of New York, London, and Beijing won't be empty forever. Ports will once again be bustling, and planes will be filled. It's just going to take some time. Hey everyone, I hope you enjoyed this video and found it informative. I'd also like to know how you've been personally affected by the shutdown, how you're coping with it all, and how you've been keeping busy. Let me know in the comments below. And if you found this video useful, make sure to hit the like button and subscribe for more content. Until next time.